Hello and welcome. This is the fifth session of discounted cash flow evaluation with Python. I believe this is our last session of this series. In previous session, we went over the evaluator multi-phase function and provided the inputs to the model to drive the intrinsic value of Chipotle. After all, this is just a model, is not a crystal ball. It doesn't know anything about the future, and it only spits out number based on the inputs we provide to it. And we learned when we tweak the inputs that we provide to the model, such as the additional return on cost of capital in perpetuity for a business, we saw that intrinsic value went from 37 to about 39 billion. We said this is a point estimate. However, the world is a continuous place where there is a range of possibility of outcomes. Implicitly, every input that we provided to the model is wrong and it's coming from a distribution. No one knows what that distribution is, but we can make some educated guesses about what distributions are for each parameter as well as the range around them. For instance, for regarding the operating margin, looking at the industry based on what average restaurants are earning on their operating margin, we see that number being about 15 to 16%. Maybe our low could be 12, our high could be 23, 24. And we can assign probabilities around those ranges. We can say we put more weight, more probability of 17 and a half, and less probability to 12 and less probability to 23 or so on. What we are going to do in this particular session, instead of providing a point estimate for every parameter to the model, we are going to provide a range of estimate for every parameter that goes into the model. However, in order to do that, we need to know about statistics, probability distributions, and properties of those distributions. So let me get us started and show you a couple of examples. For instance, most everyone knows about Bernoulli distribution. Think of a flipping of a coin. You either get head or tail. You either succeed or you fail. There's only binary outcome possible. The other one that is very famous is, for instance, the normal distribution. The bell-shaped curve where you have a center, we call it mean, which is equal to median with 50th percentile. And within 3 standard deviation from the mean, we achieve most of the outcomes, which we call 3 sigma to the left, 3 sigma to the right. And the rest of the data will be in the tail of the distribution, which we call them outlier. Or you're perhaps familiar with uniform distribution. Let's say you choose a number randomly from 1 to 10. 1.1 is equally likely to 1.2, and equally likely to 3.05, and so on. So in order for us to provide the information to the model in terms of probability distributions, we need to understand them, but it's really not rocket science. It takes a little bit of practice and a little bit of studying. I'm not going to teach them in depth or cover any of those properties in details in this session. I'm going to show you how to provide the inputs to the simulation model, but I'll provide some resources that if you are more interested in learning about this topic that you could refer to. Number one would be Statistics 101 by Professor Demodron. This is for free, available by Dr. Demodron on YouTube. You can go there, and if you click on here, you'll be taken to this YouTube playlist, and you can watch these lectures and see what Dr. Demodron has been presenting and learn more about the topics. DataCamp, Coursera are, again, 2 great resources. This is not a sponsored content by any means. These are just a couple of resources that you could refer to. But most of the things that you want to learn about the statistics, you can find them on YouTube or Medium, Stack Overflow, Stack Exchange, and other places. In a nutshell, Dr. Demodron's slide breaks it down here in his course, that what type of distribution you should be using for different parameter that goes into the model. But again, you're not bounded to this. You can choose whatever where you see it fit. The way I constructed the DCF model with simulation, I used OpenTurns library. So OpenTurns is an open source library where it's for treatment of uncertainties and risk management. It is used by professionals in field of insurance specifically, such as flood modeling, as well as finance. This is a great library to be in your arsenal if you work in risk management, insurance, or deal with any type of uncertainty and you want to build simulations or do any statistical analysis. Another great library in Python is SciPy. SciPy stats has enormous number of probability distribution, discrete and continuous. It contains pretty much all the probability distribution that we just observed in the graph that I showed you earlier. This is again a great library to be in your arsenal for a statistical analysis. The way I have created the model is essentially using OpenTerns. OpenTerns has a class named SciPy distribution where you could provide distribution from SciPy library to OpenTerns library. And OpenTerns itself has, well, most used statistical distributions such as normal, uniform, and so on. So there are a couple of ways to provide the input. You can use the distribution from OpenTerns library itself, or you could use the distributions from SciPy, but you need to include them into SciPy distribution, which I have examples here and I will be covering them. Before going there, let me show you where the function is. So this is the Monte Carlo Valuator multiphase. This is the Monte Carlo DCF model. It's very much exactly similar to the point estimate function. It takes all the inputs in form of distribution and it generates random numbers based on how many sample size we ask of it and pass those random numbers to the point estimate evaluator and drive intrinsic value. And it has one more parameter, which is the list of correlation between variables. And I will be covering it during the session of Chipotle with an example. Essentially, this is the correlation between variables. This model, a good Monte Carlo simulation, takes the interaction between the parameters of the models into account. So high level, let's say if you think your business is superior, it earns higher return on invested capital relative to their cost of capital, then somewhere in the numbers it should be seen. They could be reinvesting well, or they could have high operating margin, intuitively speaking. So you would build positive correlation between operating margin and the return on invested capital. The way it does it, it provides a normal copula functions and builds a linear relationship between those parameters. Don't want to get too technical, but all these parameters are going to have a linear relationship. If you want to make this non-linear, you're more than welcome to do so. Take the code, modify it, and do whatever you would like to do with it. So with that said, let's get into providing the inputs to the model. If you would like to know more details about every input that we provided to the model, I would recommend to go and watch previous session 4, where we provided the input to the model with some description around it. I'm not going to be talking about why am I choosing such number. I'm just going to show how to supply the distribution with its properties to the model. We call this Monte Carlo multiphase function, and we'll start filling out distribution that is needed for each parameter. So let's start with risk-free rate. For risk-free rate, we chose 4%. I'm passing a standard deviation of 0.002, and I'm choosing a normal distribution, which looks like a bell curve shape. For the equity risk premium, we chose 4.8, but again, I'm choosing a normal distribution, choosing 0.001 as my standard deviation. Let me show you the histogram of those parameters. So our risk-free rate looks like this. The range that we are providing to the model is centered around 4%, but it expands all the way to around 4.5%, and on the high side, and on the low side, it expands around to 3.3 or so. But you can see most of the data is ranging from 3.7 to 4.2%. So if you look at the cumulative distribution from 15th percentile to 85th percentile, 75% of the data being within 3.7 to 0.42. We are providing a range to the model, but we are also assigning low probabilities to high numbers as well as low numbers. But you could argue, why do you use normal distribution? You should use uniform distribution, because in a sense, I'm introducing bias here that most of the data will lie around the center with more probabilities and less probability on the tails. There could be a case to be made. We could use uniform distribution. Well, 3.5 would be as likely as 4.5. I don't see that being viable here. Maybe someone does. Maybe you would do. So you could, go ahead and change the OT.normal to OT.uniform, which, for instance, I use it for the length of a cycle. By the way, you can refer to OpenTerms library itself and see what distributions are available to provide it to the model, or you could refer to SciPy stats. For the equity value, estimate of equity value, I'm using a trinomial distribution. The trinomial distribution looks like this one. It is bounded. You determine which is what is your minimum value, what is your highest value, and where the center of the distribution is. And if you see here, I'm choosing the lowest to be 45, the highest to be 57, and I'm centering it around 51. I'm doing the same thing for the debt value. Again, I'm choosing a 3.7, more weight to 3.8, and less weight to 4 billion. Again, for unlevered beta, I'm choosing between 0.8, center around 0.9. The right side of the triangle distribution would be 1. You could observe this here. I'm getting ahead of myself, but for sake of showing it to you would be, it's okay. I think it's okay. So if you see my unlevered beta is a start from 0.8 and the highest I have is 1, but it's center around 0.85 to 0.95. Same with my terminal unlevered beta. Current pre-tax cost of debt, again, I'm using trinomial distribution. I could be using normal, uniform. Again, there's nothing right or wrong here necessarily. I'm trying to deal with the uncertainty, and the distribution that I choose is really, it's not arbitrary. They have to make sense, but it is totally viable to use normal distribution here or a skewed distribution or so on, which I'm going to get to the skewed distribution specific on revenue growth. Same with the year of cost of debt begins to converge to the terminal cost of debt. As you remember in the model, we could emphasize when that convergence is going to take place, whether for beta, or whether for your cost of debt, or whether your revenue growth or so on. I'm using the uniform distribution. However, uniform is continuous. It's not discrete. I built some line of codes in the model where it's actually going to convert floats to integer, so you wouldn't run into a problem. The effective tax rate, again, I'm using triangular distribution. For revenue base, again, I'm using a triangular distribution. Could be using uniform, again, doesn't matter because I'm not putting a huge range around it anyway. The revenue growth rate cycle begins. Here, I'm using the OpenTerms distribution class. I'm passing a SciPy distribution to it, and this is a good example to see how it passes. So here we are providing OT.normal or OT triangular directly. If you want to provide something from SciPy library, you need to wrap it into OT.distribution, then open parenthesis, OT.SciPy distribution, open parenthesis, put your distribution and close parenthesis at the end. Here I'm using a normal distribution, which is skewed towards left. If you see the location of the distribution is 14.5%, the standard deviation is about 3.2%. However, the skewness of the distribution is 2.9 on the left side, which is negative 2.9. Let me illustrate it. What it looks like. Here it is. The 50 percentile, the median, falls on 12.3. But if you see the distribution has more outcome on the left side as opposed to on the right side, it's because there are less probability assigned on this side of the distribution, on the right tail, and more on the left. Now, why is that? And then my intuition for choosing a left skew normal distribution is because high growth for Chipotle is already priced in. I'm already giving them 14% growth, and I'm having pretty sizable standard deviation around it. However, I think if there's any surprise, it's going to be on the negative side as opposed to the positive side. The growth is priced in. They're going to go for that market. They're going to go and expand. They're going to open more locations. But if there's any surprise, it could blow up as opposed to being something great, such as like Nvidia or Microsoft, working on new projects with R&D, and then all of a sudden something great come out of it. This is not something that you would expect from a restaurant business. You can't expect a positive SQ unless something magically happens. Moving along, I do the same for end of the cycle one, beginning of cycle two, end of cycle two, beginning of cycle three. And if you notice again, my cycle three, the end of it, is very much similar to the risk-free rate. So the R minus G thing that we talked about, the perpetual growth rate. The revenue growth rate at the end of cycle three in this model is your perpetual growth rate. So I'm choosing 4% with 0.002 standard deviation around it. One thing that I chose here is the length of each cycle. So if you notice in our point estimate, for length of each cycle, we chose 6 years, right? Which brought our whole valuation to 18 years total, the life cycle of the valuation. However, here, I'm choosing uniformly distributed numbers between 4 and 8 for every cycle. In a sense, I am being unbiased how long the growth would last, but I will think it would last somewhere at least 4 years, all the way at most 8 years. But again, if you look at my median, it would be 6, which would be very similar to our point estimate. The growth can last 2 more years or 2 less years. Moving along, for current operating margin, I choose between 14.5 to 15.5. I honestly think this range is a bit narrow, but again, this is not a case to sell the stock. This is a case to show the valuation. So you could expand it to 12 to 15.5 or 16 whatsoever. For the terminal, I'm choosing between 12 and 22. And again, but I'm still keeping it centered around 17.5. For the additional return on cost of capital in perpetuity, my low estimate is 0. It means I am assessing Chipotle earning the cost of capital, but not less than that. But my mid case, they are going to earn 2% more. And my high case is going to be 3.5. This distribution is not symmetric. It is asymmetric. There's more probability weighting on 2 or less than 2 and less probability weighting from 2 to 3.5. And we can visualize it here. It may not be very obvious here, perhaps, but the end of distribution is about 3.5. The beginning of it is 0, but the peak of this distribution around here, if you see, which is about 0.2. And if you look at my median is on 0.8. My median is not 0.2 anymore. Is because there is an asymmetric phenomenon here, which I am implicitly saying there's more probability that they will earn closer to their cost of capital as opposed to hitting it more than 2%. I'm giving it less probability towards the 3.5. Investment bankers come with range, medium, low, and high. And if you look at their table that they put in front of you, the numbers are all over the place. And it's essentially just for covering their analysis and saying, oh, so whatever happens, they say, oh, we told you. So if you understand probabilities and, incorporate it into your models and assumptions, you would arrive at the more reasonable range of outcomes. And if something out of the range comes out, then you have to see it, whether you didn't assess the probabilities well, or maybe something happened that wasn't expected, that were not coming into your analysis and assumptions. Now, overall, this is the model, and you see everything is repetitive. You choose a distribution, and you supply the numbers based on the distribution. So triangular requires a minimum, a medium, and a high. Uniform just wants a mean and max. Normal distribution wants a location, a scale with standard deviation, or if you're choosing a skewed, you can put the number there, and if you don't, it assumes it's going to be 0, which would be a normal distribution with no skewness. Now, here is the sample size. I'm choosing 20,000 here. Essentially, I'm generating 20,000 DCF models and computing 20,000 intrinsic value. And this one is the list of correlation between variables. We can take the interaction between the variables into account. The revenue growth rate, for instance, for cycle 3, which is the perpetual growth, is highly correlated with risk-free rate, which is the G. So if the economy is going to grow fast, the perpetual growth is going to be fast as well. It's going to be high. If the economy perpetual growth is going to be low, then hence your perpetual growth of your business is going to be low. I call them intuitive common sense correlation, which I think they don't need much explanation. The way you would provide that inputs, you would create a list, these two brackets in Python, we call it a list, and you write down the parameter name. So here it's called revenue growth rate cycle end. You put that as a string in quotations, you put comma, and then you put the other parameters that you want, which is here is risk-free rate. So I put revenue growth rate in quotations, comma, risk-free rate in quotation, and then the third parameter perhaps in this list should be the correlation, which is going to be linear again. So I'm building 95% positive correlations between revenue growth rate and the risk-free rate. And then you close the bracket, which is the list. And if you want to add another correlation interaction between parameters, you would create a new list. You pass the parameter names in quotations and the numbers that you want that correlation to be. This is a Pearson correlation to be specific. And as you see here, I put some specific valuation correlation between the parameters. Now, what do I mean by that? Every story you may say for a company that you're valuing have some characteristics. For instance, in this case, Chipotle is going to expand internationally. The risk premium that investors would demand, you could argue, is higher overseas, outside of the United States, because, well, those countries are emerging market or they're well developed, but it's still not as mature as the United States. There could be more corruption, more bribery, things like that. Then, there's more risk in those countries to conduct businesses as a whole. So risk premium is going to go hand in hand with the revenue growth rate. If you're expecting higher growth and your growth is going to come outside of the United States, well, perhaps you should demand a higher risk premium. And in order for you to take that into account, you can do it with these correlations. I am building a positive correlations between equity risk premium and the revenue growth rate between cycle 2 and 3. The higher those numbers would be, the higher the equity risk premium would be, which also makes my cash flow to be larger, but also discount at a higher number, which makes the present value a little bit smaller. But again, that correlation, I didn't put 100%. I just put a 40%. And honestly, these numbers are just arbitrary. I could put 35, I could put 30, I could put 45, or maybe 50. But think of these numbers to be reasonable. These are the additional return on cost of capital in perpetuity, which I spoke about. So if they're are able to earn more than their hurdle rate, well, they reinvest well. And where does it show up? It shows up in their sales to capital ratio. Where else it could show up? It could show up in their operating margin, internal operating margin or current operating margin. So in a sense, I am here bringing these interactions into my calculations and my equations and saying that these things are not mutually exclusive. When we run this model, we pass these inputs, we store the output in df underscore valuation. This is a data frame. If you look, this data frame has 20,000 rows. I am executing .tail, which shows the last 5 rows. And these are the inputs that went to the model. So in this particular case, your risk-free rate was 3.9, equity risk premium was 0.49, equity value was 49 billion, debt value was 3.8, unlevered beta was 0.86, terminal levered beta was 0.97. It started to converge the next year immediately. Pre-tax cost of debt was about 6%. Terminal tax cost of rate was 5.6, and so on. And if we just scroll to the right, this model gave us an equity valuation of 32 billion. The other model gives us 30 billion. The other one gave us 32.4. The next one gave us 28, and the next one gives us 36. So you can go over, examine every your row if you would like to. But when you do 20,000 DCFs, it makes it difficult to understand exactly what happened in each model. So one way for us to visualize that, I have created the valuation describer. We pass the df underscore valuation data frame into it, and it's going to plot these histogram for us. I'm going to cover the other chart on the top at last. You can see how your revenue growth for cycle 1 looks like, how your revenue growth for end of cycle 1 looks like. Same for cycle 2, beginning, ending, cycle 3. Here is your equity risk premium distribution, additional return cost of capital and perpetuity. Here's the terminal reinvestment rate. This is essentially what I talked about. The expected growth rate is equal to return on investment times reinvestment rate. So in order for them to grow in perpetuity around by 4%, they need to reinvest about 40% of their operating income back into the business. This is the terminal after-tax operating income at maturity. You can see the firm valuation at maturity, what it would be. This is the terminal free cash flow to the firm. Again, these are at maturity numbers. The unlevered beta from the beginning and the terminal unlevered beta, the current sales to capital ratio, the terminal sales to capital ratio, the current operating margin, and terminal operating margin, as well as the terminal revenue. So at maturity, how much your business is expected to earn. This is a very powerful chart for me to sanity check what I've done. In my 50th percentile, the revenue at maturity is about 54 billion. 15th percentile is 42, and 55th percentile is 72 billion. And if we look at our point estimate, at maturity, at the year of 18, terminal revenue was 56. And here in my simulation, my terminal revenue came to 54, which is in line with my median point estimate in a sense. Here you can see the cumulative distribution of intrinsic value. And here you can see the histogram of the intrinsic equity value distribution. So my low estimate would be 28 billion. High would be 44, and my mid case 50th percentile would be 36 billion, which is again very similar to the point estimate that we got. And we are seeing the business to be around 50 billion, which we find it to be overvalued, which is perhaps around the 90th percentile or 90 something percentile, which quite frankly I think is expensive. Now here, this chart shows the return on investment. Essentially, if you buy the whole business for the given price as it is today, and the story that we just say up there materialize, what would be your expected return? The cost of equity is how much you should be actually be making. The green line is how much you should be expecting to make. So if you see the bar charts on below are negative, it's because you are not earning the hurdle rates because the stock is overvalued. And given what you would pay, and let's say stock remains overvalued, whatever, you could well be making 5 times of your money if the story we said materialized, but you should have expected to make 7 times of your money in 24 years, not just 5.9 times. This table shows the intrinsic value by decile. So if you look at the 50 percentile, the equity value is about 36 billion, which translates to about $1,300 per share, because the stock is around $1,800 per share right now. 2 things that I haven't covered. This is the model variable Pearson correlation with intrinsic value. What it means with that intrinsic value that we calculated, which parameters had the highest and the lowest correlation, positive or negative, with the model. And well, equity valuation by itself has correlation of 1, which makes sense. With the firm valuation has correlation of 1, which makes sense because we value the firm, we subtract debt, and we add cash to arrive at the equity value. The next parameter is the terminal free cash flow, again, which makes sense. The larger that number is, the higher the equity value would be. The next is after-tax operating income. Again, that's state the obvious. But you see the next parameter that is very important is your terminal operating margin, 70% correlation. The next one is terminal revenue. Again, makes sense. That one is additional return on invested capital in perpetuity. It's 46% positive correlation. So the higher that number, the higher it impacts the intrinsic equity value. This would be a good chart to sanity check which parameters you need to perhaps be careful and emphasize on the inputs that you're providing to the model. So if this is going to impact my valuation a lot, maybe I want to double check my additional return on cost of capital in perpetuity. Did I have a good assessment? Did I, put a number in there that is reasonable? Maybe I should stress test it, or maybe I should put more standard deviation around it, or maybe I should use a different distribution. So this chart is going to be useful how to think of your choice of distributions and how to stress test them. So I cover on the positive side. You could the same thing holds water on the negative side. So again, terminal reinvestment rate has the highest negative correlation, which makes sense. They have to put more money back into the business to sustain the business. And the higher that number, the lower your free cash flow to the firm, the lower your intrinsic equity value. Now, this one is simulated invested capital. Just think of it as if it was your balance sheet, if your balance sheet was going to grow, because we a base number based on what we see on the balance sheet, they have about like 6 billion in assets. And we calculate how much they have to reinvest back to the business, and we add to it, we accumulate, and we can calculate what would be the invested capital and what would be the return on investment. Again, this is somewhat informational. It's kind of to make sure your reinvestment during your simulation that is happening, it's making sense, nothing is out of bound. But again, this is only the median estimate, just the 50 percentile of the distribution for each year. With that said, I hope you found this series useful. I thank you very much for listening, learning about valuation, being curious and patient with me to get you here. If you have any questions, feel free to put them into comments. I'd be happy to answer them. I apologize for my shortcoming of explaining anything here. I'm not an expert. I'm not a teacher as much as I would have loved to become one in one day in the past. This was just my attempt to show how I think is the right way to do intrinsic valuations. You are more than welcome to download the code, make any modifications to it, make it more reasonable, more realistic than it is now. Yeah, that's pretty much it. Again, I thank you, and I hope you enjoyed the session, and I see you in the next video.